Good morning, everybody. Happy Tuesday. We have an amazing show for everybody today. What do we have, Krystal?
Indeed, we do. I'm doing the show remotely because my kiddos had first day of school, so I had to be mommy first this morning. But we nevertheless have a wonderful show for you. We have some really interesting stories, I think, about the state of our culture and our nation, starting with numbers on real estate and especially apartment buildings and a potential coming reckoning. So we will get into all of that. Also, some fascinating new numbers from Gallup about the widening polarization and divides between the two parties on a whole variety of issues. Kind of interesting which issues have become the most divided over the past number of years. We have a potential new opponent of Joe Biden in the Democratic primary that the media is actually taking seriously. We'll tell you about that. Possible huge breakthrough in terms of what is being described as the holy grail of energy. This is something we covered before. They've been able to recreate that fusion energy generation. So we'll break that down for you. And it seems that more and more employers, including the federal government led by Joe Biden, are pushing their workers back into the office after quite a while where workers have been working more remotely and hybrid. So we will talk to you about what all of that means. Before we get to any of that, though, thank you guys so much for what you've been enabling in terms of our interviews. Really enjoyed getting to sort of spar a little bit and press one of the Biden representatives that we had on set yesterday, which is something we honestly have never really been able to do before.
It's true. Yeah, that's right. We're going to continue to have him back. I'm excited to spar, I think, with him just a little bit more. We got to get some more into the weeds. We've also got some very interesting guests that I'm excited to debut here with you, Krystal, to the show. We can't reveal yet some of our methods, but I think people are going to enjoy it. Once again, it is only a testament to some of the shocking people who do agree to come on the show to what has been built here by our audience. So breakingpoints.com if you are able. We want to take a step and actually look at some of the big macro problems that are facing the country. And one of the ones that we hear from you guys all the time is about housing. And so it's not just, though, that housing market and how it's affected your own personal life. It really also relies on the commercial property sector. And something that Krystal in particular and I have been really looking into is about the debt bomb that could come as a result of work from home and the economic changes that have come since the pandemic. So let's go ahead and put this up there on the screen. We're beginning to see this now materialize in the marketplace as interest rates begin to rise. What you guys can see in front of you is a piece from the Wall Street Journal with two very important parts. One is called, quote, "The Real Estate Haven Turning Perilous with Roughly $1 trillion Coming Due." You can see there that the outstanding multifamily mortgages from the Mortgage Bankers Association has reached well above the normal level of 2010, increased throughout the late 2010s, but has now come to almost $2 trillion. What you can also see in the costly loans chart there, which is on the right for those who are watching, is that the apartment mortgage rate is dramatically higher than the 10-year Treasury yield, somewhere between the 5 and the 6%. That's just on average. And of course, increased interest rates are continuing to put pressure on that. And so what they call this is that it's $1 trillion coming due in loans. Nobody knows if these are actually going to be able to even make them. Many of these, quote, private real estate firms are funded mostly by floating rate debt and small investor cash, now have even bigger competitors in the multifamily market. Some paid high prices based on rosy expectations of steep rent increases for years to come, and now they are having trouble making the math work. They have already shown that there's a huge amount of acquisition happening in the space. And in some cases, Krystal, these loans are not even able to be acquired by some banks and some purchases out there. So this could have a massive impact on our economy and on our banking sector in particular.
Yeah, that's right. So there are a few categories of commercial real estate that are really in trouble right now. One that we've talked about before and which has gotten a lot of attention is office buildings. Understandably, people are working remotely more now. I mean, the vacancy rates are extremely high. And so you have a lot of office buildings with, high vacancy rates, much lower valuations, and with interest rates rising because of the Fed, this not only ups the mortgage rates for, residential homes where people are just buying homes, this also really hikes interest rates for all sorts of commercial properties. So you have that as a very obvious problem and a lot of that debt coming due, what's been described as a debt bomb sort of looming over all of that. But the second most troubled class is actually apartment buildings. And this has escaped some notice. But traditionally, this class has been seen as very sort of solid, very reliable. Of course, people have to have a place to live, they have to be able to make their rent. And so some of these property owners thought that they could just raise rents into oblivion and that would be able to make the math work. But with interest rates going up as rapidly as they have, a lot of them are now in really tough positions. So from that article that we had, you have one, Peter Sadaloff, they describe as a veteran real estate finance executive. He described this as a hydrogen bomb scenario. You also have some indications that even more sort of solid, long-standing groups in this space that are having trouble. They say some veteran real estate investors that weathered past storms look vulnerable. Veritas Investments, one of San Francisco's largest landlords and partners, defaulted on debt backing 95 rental buildings during the past year. It stands to lose more than 1/3 of its San Francisco portfolio as a result. So obviously, if you've got landlords that are struggling and that are trying to pass the buck onto their tenants, trying to hike rents, that's going to be a huge issue. If you have landlords going into default, if you have cascading impacts on the banking sector, this all has potentially massive ramifications.
Yeah, and as I referenced earlier, let's put this up there from Bloomberg, another great chart that we can actually go ahead and show people, which is that many of the property loans that are outstanding right now are so unappealing that the banks, quote, want to dump them. What they point out is that commercial property loans have a massively dried up market with very few options for an easy exit. All these lenders, including JP Morgan, Goldman Sachs, they've been trying to sell debt, which is backed by office, hotels, and apartments in months, but are having trouble actually finding anybody to buy this because nobody believes that the underlying loans will actually be made whole. And as you can see, actually right in front of you, it shows why apartments is really second to office buildings in what's in trouble. Property values are down some 30% in the office sector just over the last 12 months. Apartment buildings, on average, almost down 15%. Hotels, industrial, seem to be hanging on. Malls, we did an entire segment about that, and even self-storage have taken a hit to some degree. So you have two problems there. Not only are you having the interest rates continue to go up on mortgage and on loans and some of these adjustable rate things, but you're also seeing an overall decline in the value, so these guys can't even sell it without being made whole. So this is a real nightmare scenario because the banks can't get anyone to buy the debt, and then once these people do default, if they do want to sell the underlying asset, they'll have to sell far below maybe even what's outstanding on the actual loan. So the big problem is that a lot of this also is concentrated in previously prosperous areas. As you referenced San Francisco, I was reading that the tri-state area in particular, which has suffered population loss during the pandemic, has also been suffering. And of course, they have had the biggest problem in terms of work from home and how much of their economy, even here, Washington, D.C., many northeastern cities, relied on office culture. I think it relates to remote work, the block that we're going to be doing later in the show. But, the economic changes here could have a serious effect as all these loans come due. And we already know, Krystal, that the bailout calls are going to be coming soon. There's just no way they're going to be able to take this laying down. And I think that's why we're trying to prep everybody for it.
Yeah, and there's a couple other things to say about this. So the trouble in the office space class and the trouble in the apartment building class is a little bit different. So for office space, you both have the fact, and this is why office space is the most troubled, you have the fact that interest rates have spiked and you have these super high vacancy rates, especially in cities like San Francisco, cities like LA, cities like New York. Apartment buildings are actually full. They have low vacancy rates. We've had an issue of not having enough apartment buildings being built, too low supply. There's actually, I just saw some charts about how there's a huge increase in the amount of apartments that are coming into the market. So that is good news for renters. So the issue for apartment buildings isn't low vacancy rates. The whole issue here is basically interest rates. The fact that the Fed hiked rates at such a rapid pace by historical standards, that's what's caused all the stress in terms of that asset class. And you had, some new players that got into this game that came in with a set of assumptions that turned out not to be true. And so they just can't make the math work now. But one other commonality with the office space is how much of that debt is now coming due. So banks, they see this writing on the wall. They see that these assets that they have are in trouble. They're trying to offload them in some sort of an orderly fashion, and they just can't find buyers. So even though in some cases they're willing to take a haircut just to have liquidity so that they have some sort of, stable basis and they aren't overly exposed, they aren't able to find anyone to take the deal. So it's hard to even say at this point what the appropriate valuations are because there are so few buyers in the market to actually figure out what the market valuation is. They flagged in that article one potential big sale that's being managed, they say, by brokerage Newmark Group Incorporated. The FDIC, the Federal Deposit Insurance Corporation, is actually seeking to offload $60 billion of real estate-backed loans that they ended up with because of Signature Bank failing. So FDIC ended up with this, $60 billion in real estate-backed loans that they're now really trying to offload. So that's going to be one indication of exactly where these valuations are, since they kind of have to get rid of the assets that they have.
Yeah, and this is all, like I said, it's going to be looming over the economy. It's going to affect bank stocks. The banks themselves are very much paying attention to this. Put this up there on the screen. This is a quote from the Goldman Sachs CEO just from a couple of days ago. He says, quote, "There is no question the real estate market, in particular commercial real estate, has come under pressure." That came directly as his own bank is trying to unload hundreds of millions of dollars worth of loans from his actual portfolio and trying to sell it off. So there you go. Everybody keep an eye on that, because you can certain that if they do fail, they'll have their hat in hand and come in here to Washington asking for money.
Hey guys, if you like that video, go to breakingpoints.com, become a premium subscriber, and help us build the best independent media organization on the planet.
That's right. We're subscriber funded. We're building something new. We want to replace these failing mainstream media organizations.
So again, to subscribe, it's breakingpoints.com.